set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Google preparing to cut 6% of the global workforce. Senator Mitch McConnell says the US will never default, and top Fed officials determined to stick with high rates. We begin with a big issue, the Fed's last word.
We have a Fed here who's not backing down.
They're very concerned of being the Fed that paused too early.
Some speakers, members being fairly hawkish, some less so.
Inflation is on its way down. The economy is slowing.
We hope that the Fed will engineer a soft landing here in the U.S.
This has the signs of being a soft landing.
We think that you're going to get a recession.
But the jury is still out.
We have amongst investors a very, very different view.
We're in the don't stop camp.
We're more in the stop camp.
Maybe another 50, 75 basis points certainly does the trick.
We think 25 more basis points.
The Fed needs to get truly restrictive. I agree with Bullard on this.
Lower terminal rate, staying there for longer.
Just a fantastic lineup this morning, and I'm pleased to say we kick things off with Mohamed El-Erian of Queen's College, Cambridge, and Bloomberg Opinion. Mohamed, fantastic to welcome you back to the programme after about a month, so thanks for coming back, sir. Let's start with this 25 versus 50 debate. Are we ready for that downshift all over again?
It's a really tricky one, John. There's good arguments for both, 25 or stay at 50. There's support from data, depending on what you look at. If you want to go to the 25 camp, you look at the retail sales numbers, you look at the curve inversion. The 50, you look at the labor market, and there's downside risk to both. So it's a really interesting debate. I'm not sure there is the right answer. And then you have to factor in what the market is pricing, which is not what the Fed is telling us, and the credibility issue. I think if you put all that together, I would go personally for 50. And that's because I think inflation is going to get sticky in mid-year at around 4%. And I'd rather get the tightening out of the way now than when the economy weakens. But it's tough. It's a personal judgment. I'd go for 50.
You would typically break this down as pace versus destination. So this is about pace. Does the pace tell you anything about the ultimate destination?
It doesn't. The ultimate destination itself is a variable. The real question is, do you want to link the pace to the destination, where some people are tempted to do that? Say, go slower, but go for longer. I don't think that's a good idea. I think that if you look at the two-sided risk of that approach, I think it tilts too much on the downside.
Back in June 2022, so last summer, I remember the article you wrote in the FT, and I brought it up this morning, and the headline was the risk of flip-flopping. And you wrote this: there is a danger of the classic stop-go trap that haunted many Western central banks in the 70s and 80s. Mohamed, do you think that weighs on them?
Oh, it absolutely weighs on them. Just listen to what Chair Powell says over and over again, as well as other Fed officials. It absolutely weighs. They do not want to be remembered as the central bank of the 70s that made that mistake. And that's why they are maintaining a hawkish narrative, even though the market is not listening to them. It's very strange, John. You know, I grew up when the paradigm was forward policy guidance mattered, and the markets really listened to forward policy guidance. Here we've had one Fed official after the other repeat the same message: we're going to 5 and above and staying there, and the market saying, I don't care.
Do you think that's a credibility issue?
I think it is a credibility issue, and I think it is also a market conditioned by a Fed that has always tilted dovish whenever things got difficult.
Well, things are getting difficult right now, and let's think about how they're approaching it. We heard from the Fed Vice Chair yesterday, and really President Lagarde echoed what she said already. We heard this from Brainerd: we're determined to stay the course. We heard this from Lagarde: staying the course is my mantra for policy. What was interesting about the speech, if you read the body of the speech, thinking out loud was a phrase that Kit Dukes of SocGen used this morning. The body of the speech was thinking out loud about a soft landing. And there was this quote right here: it remains possible that a continued moderation in aggregate demand could facilitate continued easing in the labour market and reduction in inflation without a significant loss of employment. Now, traditionally, that's not how we think about this. Bob Michael of JP Morgan spoke to our team here at Bloomberg earlier this week, and he said the equation was simple. Inflation doesn't come down until wages do. Wages don't come down until employment rises. Unemployment rises. Unemployment doesn't rise unless we are in recession. Mohamed, which one is it?
So that's not the end of the thing, right? I mean, that's the trouble, is that the debate has stopped where you stopped. And because of that, you end up by saying we cannot have financial stability in terms of inflation without high unemployment. What about labor force participation? What about better skill matching? You know, we can get there. And had the Fed started earlier, the risks would not be as high. But let's talk a little bit about what else needs to be done. This excessive focus on the Fed means that we're not looking at things on the supply side that would resolve a lot of the uncomfortable trade-offs that we're seeing on the policy front.
Something we need to discuss more, something we won't hear more of after today is Fed Speak, and that might be good news for some of you. It is the final day before the quiet period, so the Fed Speak ends today. We're going to hear from Harker. We're hearing from him right now. We're going to hear from, a little bit later, from Governor Waller, and with Michael McKee, the Kansas City Fed President. Mike McKee joins us right now. Morning, Mike.
Good morning, John, and you're right. This is the last day for Fed officials to get their thoughts on the record before they make their next move on February 1st. Pat Harker, as you noted, is speaking right now. There's a tinfoil hat kind of theory on Wall Street that Jay Powell calls these guys into his office and says, here's the message, everybody go out and give it. They don't do that. They give their own individual messages. It's just sounding coordinated these days because Harker, like everybody else, is suggesting it is time to dial back on stimulus, but not to ease the overall pressure. Here's a quote from his speech right now. I expect that we will raise rates a few more times this year, though to my mind, the days of raising them 75 basis points at a time have surely passed. And he goes on to say, at some point this year, I expect the policy rate will be restrictive enough that we will hold rates in place to let monetary policy do its work. That's a very similar message to what we heard from the Fed leadership last night. You already mentioned Lael Brainerd, also John Williams, the vice chair of the Open Market Committee and the president of the New York Fed Bank, saying much the same thing. And they used almost identical language in laying this out. While there has been progress, both said, even with recent moderation, inflation remains too high, according to Brainerd. And with inflation still high and indications of continued supply-demand imbalances, it's clear that monetary policy still has more work to do. Now, Brainerd and Harker said almost explicitly they're looking for 25 at this meeting. Enough people have said that I think you could pretty much put that in the bank. But to get back to Mohamed and what he was saying, the market's just not listening. You look at the forecast for what happens this year ahead, and even with all this Fed speak, you have not seen much change in the market's view that the Fed isn't going to get as high as it thinks it's going to get. The question then becomes, how long can they keep wherever they get to in place before they have to give in? A couple more speakers today. As you mentioned, we are going to be speaking with Esther George at the top of the next hour, and we also hear from Chris Waller of the Federal Reserve Board of Governors, who has been hawkish in the past, so I would expect much the same message.
The last word before the weekend of the quiet period. Mike McKee, wonderful. Looking forward to the conversation a little bit later as well. Don't miss Mike's interview with the president of the Kansas City Fed. That takes place at 10 a.m. Eastern Time, around about 52 minutes from now. Mohamed, I want to come back to you. There is a disagreement here, as you've indicated, between the market and the Federal Reserve communication. At the centre of that, I think, is a disagreement over the way people look at the data. The Fed says they're data dependent. We need to talk about what data they're dependent on. If I look at the hard data, it's mixed. You've still got claims at 190,000. I look at the soft data, it's terrible. The ISM manufacturing services, sub 50 in contraction. Mohamed, how much weight do you put on each?
So it's very difficult, John. It really is difficult. I think, what do we know for sure? And you should have asked Mike, why does he think the market is not listening to the Fed? Because I think Mike's insight would be really important on this. Look, what do we know for sure? We know inflation dynamics have morphed. It is no longer about food and energy. It is no longer, in general, about the goods sector. It's about services. And services are much less sensitive to monetary policy. That is a real issue. And that's the cost of being late, is that inflation moves to places that you cannot influence as easily. That is why we have three sets of disagreement. John, one is between the market and the Fed as to where is our rates going to go and how long are they going to stay there. Second, within the Fed, yes, it's probable that we get 25 basis points, but it's not a done deal at all. There are some who favor 50. bullet being an example. And third, within the market, when you ask people why are you pricing in cuts in the second half of the year, you get two views. You get the nice view because we'll have nice disinflation, and you get the ugly view because we're going to have a recession. So this is full of disagreement, John, because there's so many potential outcomes here.
One is positive for markets, the other one much less so. Mohamed, let's build on that. You said there were 4 risk factors a little bit earlier this week when you published for Bloomberg Opinion. Buoyant markets need to watch 4 risk factors. Which risk factor haven't you mentioned yet?
So the one that worries me, because it's low probability, high impact, as you know, is market functioning, it's liquidity. And that one, thank goodness, hasn't been in play. I think the beginning of the year, and that's why I put that article out over the weekend, the beginning of the year, the market simply got too complacent about growth, inflation, and policy. They embraced a narrative which is a wonderfully comforting narrative, but a low probability narrative. And what we've seen this week is a readjustment of that narrative.
Doesn't China's reopening influence that conversation, Mohamed, and to what extent?
So, you know where China's reopening influences the most, John, which is not being talked about except by 1 or 2 people, including the head of the Norwegian Central Bank Sovereign Fund, is whether that creates a leg up in goods inflation later in the year when service inflation is still an issue. For the short term, this is a very messy reopening, really messy, in terms of what's happening on the ground, COVID cases, the pressure on the health system. It's not a smooth reopening in any way. So it's not that demand is going to shoot up and everything on the supply side is going to be fixed. It's going to take a few months for that to happen.
Let's put a bow on it then. If they stopped hiking after the next meeting, do you think there's a real risk they'd have to start again in the second half?
Yes, absolutely.
That's a big problem.
Yeah, and that's why I'm in the camp of actually get more done now when the economy is still doing well. Otherwise, you may end up having to do more later when the economy is significantly weaker. And that would just repeat the mistake of 2021 and 2022. Let's not repeat that mistake.
What do you think the biggest spread is now between you? Between you and this Fed, or between you and market pricing?
That's a really good question, John. I don't think I can answer that question because I see many potential outcomes to growth. What I do know is if I was in the Fed and I would look at my mandate and I would look at the balance of risk, I would continue hiking and I would ignore the markets for now.
Mohamed, this was great and it's been too long. Don't leave it a month again. It's too long for us. Mohamed El-Erian there at Bloomberg Opinion and Queen's College, Cambridge, one of the very best and a good friend of this programme. Equities right now on the S&P up 0.25%. The big debate continues on Capitol Hill.